Hi everyone, welcome to this session of the Tiger Academy, US Stock Financial Statements for Beginners. In the previous lesson, we have learned that financial statements are physical examination forms of companies. Today, let's take a look at the content of income statements, the simplest one among three statements. You may be curious why we're starting with the income statement. Vincent Wong, head of Tiger Community, said, "Income statement shows the financial muscle of a company. By reading the income statements, we can learn about its operation and business model." How do we understand income statements? It's very simple. Let me walk you through it with a real-life example. Let's take a look at this chart. The income statements include three key numbers: revenue, expenses, and net income. There are many subdivisions under these three major categories. For example, costs and expenses include selling, general and administrative expenses, research and development expenses, and depreciation expenses. Other expenses are the total cost of interest expenses or other non-operating expenses. You may feel confused with so many terms. It's okay. You only need to understand one thing: how to calculate profit. Let me give you an example. At the end of the year, you want to calculate how much money you have earned this year. The most basic formula is income minus expenses. The same goes for the profits of companies. I'll use Jack's monthly living expenses to demonstrate for you, and you'll understand. Let's start with Jack's monthly income and expenses. First, Jack's income. Jack works in a company and doesn't have a side job, so his income is his salary, $4,500 per month. We can write down this number: income, $4,500. The personal income here is actually equal to company's revenue, which is the money you've earned. Second, Jack's expenses. Jack needs to pay $1,830 for housing, food, transportation, and other essentials every month, no matter what. It's pretty much on a fixed schedule. Similarly, companies have fixed expenses to keep its operation, which are called expenses. For example, a technology company like Nvidia has to invest hundreds of millions in R&D every year. A consumer company like Coca-Cola has to spend tons of money to maintain sales channels. A car company like Ford has depreciation expenses for its production equipment annually. In addition to fixed expenses, we have to pay personal income tax every year. Jack has to pay $270 on average every month. Public companies pay a large amount of income taxes. What's more, we also have some unexpected expenses. For example, when Jack's friends or colleagues get married, he needs to give them a wedding gift. Such non-essential expenses are called other expenses. If you want to buy a new MacBook Pro, Jack may have to pay by installments, with an interest of $120 a month. Companies also need to pay interest. For example, some real estate companies borrow money from banks to buy land and construct buildings, and the company pays banks back with a large amount of interest every year. This is all of Jack's monthly income and expenses. We can then calculate Jack's profit easily. Jack's profit equals salary minus fixed expenses minus other expenses minus income taxes. Therefore, we can get one company's net income equal revenue minus cost of revenue minus other expenses minus income taxes. It's very simple, isn't it? A company's income statement is basically a bigger personal budget. In the following lesson, I'll explain the SG&A expenses. They can tell you more secrets about one company. Well, that's all for today. We have learned that income statements can show a company's profitability and can tell us whether a company earns or loses money. It's pretty much like a big personal budget. In a personal budget, we focus on the money we saved every month. In the income statements, we look at the money earned by the company, that is, the net income. The equation is net income equal revenue minus cost of revenue minus other expenses minus income taxes. Many investors often focus on the revenue and believe that strong revenue means future success. But is that really the case? In our next lesson, we will answer this question.